Welcome back. Well, Chandan Taparia, the derivative and technical analyst at Motilal Oswal Financial Services, is joining in. We're at 9 a.m. this morning, so we have the pre-opening rates that will kick in just about now. Chandan, good morning. What are your thoughts on the index itself? We've seen a recovery from the lows yesterday, but for today, what's the plan and what are the individual stocks you're looking at?
Good morning, Sonia. So finally, this strong expiry is coming to an end, and tomorrow we have the monthly expiry. So on expiry basis, as of now, the Nifty is up by 11%. However, we have seen some decline from 18,000 marks, but overall it's up and trading much higher than its volume weighted average. So we believe that support could be placed and some short covering may trigger in next 2 days. And broader trading range could be 17,442 to 17,777. So any decline would be buying opportunity with support of 17,442 and market can again once bounce towards 17,700 to 17,777. Now looking at the Bank Nifty index, that is outperforming up by around 15% in this series, much higher than its volume weighted average of 37,000, but near to the weekly volume weighted average. So 38,000 to 39,250 is going to be the broader trading range for the Bank Nifty. Now looking at the individual stocks, we have seen good run up in the market, and this is the positive expiry after the 3 negative expiry if you talk about the Nifty as a whole. So 3 stock ideas mainly from the auto, gas and selective counters. So first that is buy on M&M. This stock has seen the good momentum as a trend is positive. Recently in time of consolidation, it took support near to 1220 zone. We have seen 48% rollover. Short covering is likely to happen with long rollout to build. So recommending to buy on M&M with a stop loss of 1245 and expecting it to rally towards 1335 marks. Second trading idea, that is buy on BL. This stock is continuously forming higher tops, higher bottom on the weekly scale. We have seen 57% rollover as of now on D-2. Short covering is clearly visible. So expecting further momentum in the counter led by its strong price pattern. One can buy with support of 292. And here we have a target towards 310. Last trading area, that is buy on IGL. So IGL has seen the correction in last 4-5 trading session, but exactly taking support at the previous breakout zone. So that is a classical example of the role reversal in a technical pattern. The stock has seen the rollover of 70% and is up by around 20% series on series basis even after the decline. And this stock has given a consolidation breakout of last 6 series. So expecting good rollover and the momentum in the counter after retesting of the support. So recommending to buy with support of 400 and expecting momentum to extend to us 440 to 445 levels.
Okay, thanks a lot for that. Have a great day. So that's the word coming in from Motilal Oswal on the F&O ideas. We still have Devin Choksi with us. By the way, the pre-opening rates are settling much lower actually, down almost about 1% on the index, the Nifty that is. The Sensex as well is down 235 odd points. Just pull up the Nifty constituents for you. The drag is really coming from names like Bharti Airtel, Hero MotoCorp, Maruti, Suzuki, ICICI Bank. So basically it's profit taking that you're seeing across the board because these are stocks that have done quite well. NDTV, by the way, is still up about 5 odd % in pre-opening. So we'll watch out for that stock closely. And on the upside, ONGC, Dr. Reddy's, Wipro are a couple of stocks that are in the green. But Devin Choksi is still with us. Devin, on the IT names, because of this variable pay cut, we spoke about it yesterday and a couple of days ago as well. Do you think the worst of the news is priced in? And what would you do with some of these large cap IT names now?
So, Sonia, my understanding is that I think these are the challenges, I think, which is likely to continue for some more time, I would think. I think on one side, you have a significantly large amount of shift taking place in the global market, wherein IT is becoming, I think, more of a service item, more of a consumption item in your P&L. Apart from, I think, the capital investments, I think amount of subscriptions are being taking place, I think, for the services that one is using in the IT side. So the demand for the IT services, I think, on rise. And when you look at the likes of TCS, likes of Infosys and such other companies, even in mid-tiers, I think they are basically acquiring the customers with a 5 to 7 year kind of a contract. And in some of the cases, I think they're $1 billion contracts. Some of the cases, I think they're $100 million plus contract. And the mid and small size companies, I think, are talking about $10 to $50 million contract as well. So I think this is one area where I'm observing that I think the demand scenario remains extremely strong. And as far as I think the growth is concerned, that provides good amount of visibility for the next 5 to 7 years for each of these companies in different contracts. On the other side, yes, the challenges are related to the attrition. Challenges are related to retention of talent. And as a result of which, I think the companies are finding it slightly difficult at this point of time, or largely difficult, I would say, at this point of time in managing the cost. So maybe this is a transitionary phase as I see it. Maybe I think we are likely to see some resolution to this particular subject over next few quarters. How it will happen, how soon it will happen, I think the time will tell. But I would think that many of the larger companies would be in a better position to deal with this kind of challenges that they are facing currently. The good part is the business, I think, which is continuing to grow. And that is where I still remain more confident in IT companies and their business models.
Okay, just looking at some more names, by the way, in the pre-open, Bharti Airtel is down about 2%. That's interesting. It's been one of the strongest stocks. Maruti Suzuki is the other one. Now today crude is up, so perhaps that will have some impact on some of these names. Kotak Mahindra Bank is the other one. In fact, Devin, a word on Kotak Bank, because there was this expectation of FTSE inclusion that didn't happen. But the stock's been a rank underperformer regardless. What would be your view here?
So, Anuj, I think I like the bank, I think largely from the point of view that they are extremely measured as far as I think their approach to the credit expansion is concerned in the book. And I think in last 2 years, when the situations were uncertain, I think they applied, I think, good amount of breaks in expanding their book. So to a greater extent, I think they are not getting the advantage of, I think, improved economy at this point of time. But having said that, in the current year, I'm seeing the strategy is to acquire the larger amount of corporate customers. And that is where I think probably the bank is positioning well. The retail part of the business continues to do well as far as I think most of the corporate banks are concerned. In my viewpoint, I think those lenders who are careful about, I think, not expanding the book in uncertain times, I think they do protect their balance sheet from getting into the trap of NPAs. And that's what I think the likes of Kotak, likes of Bajaj Finance have, I think, shown with an example. In my viewpoint, fundamentals are remaining in place. Most of the franchises, I think, that the company has built within their entire organization, most of the BUs that they are operating with, they are basically value accretive. In my viewpoint, I think stock remains, I think, a good choice to invest into the portfolio. I believe that I think the fundamentals are strong, and probably I think one could possibly have, I think, better results going forward, given the kind of approach that they are now having for expanding the book size, particularly on the corporate loan side. I think that is where I like to buy the stock, I think, given the opportunity at this point.
Okay, Devin, we'll let you go on that note today. Thanks a lot for joining us. Have a good day. The pre-open has settled 52 points lower on the Nifty. So let's see whether this gap down gets bought or not. Sudarshan, if we open here, what kind of level do you wait for before buying, and what's the 9-10 call?
More than that, I would like to wait in the afternoon for the Nifty to settle down and move sideways. If that happens, we have a stop loss below the consolidation level, and there would be a buying opportunity. Coal India is a buy with a stop under 213.
Mitesh, your 9-10 call?
I would go with buy on Balrampur Chini with a stop at 344 for targets close to about 370.
Balrampur Chini is a buy. Mitesh, Sudarshan, thanks a lot for those calls. Let's now focus on the IT sector. It's been in focus after Wipro. Infosys has also trimmed its average variable payout for employees to 70% for the June quarter due to margin pressures. Brokerage house JP Morgan has now downgraded all its remaining overweight calls on IT players to neutral. They had downgraded some earlier, now downgraded all because of the margin pressure. Ankur Rudra, India Telecom and IT research analyst at JP Morgan, is now joining us. Ankur, hi, good morning. Thanks a lot for joining us. Now, the big issue on IT companies, apart from the margin, is on the valuation, right? I think maybe it was your note itself which was saying that the stocks are still trading at 40% premium compared to the pre-COVID levels. Do we see more valuation reset from here on?
Hi, good morning, Anuj. Thank you for having me. So I think valuations clearly do not bake in our view. The kind of margin pressures which will have an impact on estimates, especially the earnings estimates. We think there's significant downside risk to earning estimates given the margin pressures we've seen so far are likely to persist at least in the medium term. So as the market adjusts itself to that new reality, in addition to potential slowdown on the macro front, we think that itself will make, for example, the existing valuations look even fuller than you currently see on consensus. And secondly, given we are at, as you highlighted, 40% above pre-COVID average levels on the long-term basis, there seems to be not any support on the valuation front. We probably will see some, we should see some correction here for them to come to more reasonable levels.
Problem also, Ankur, is, and we've discussed this repeatedly in the past as well, is that it's any case historic lows in terms of margins for companies like Infosys and Wipro, right? If I'm not wrong, TCS margins are at what, a 14-year low, HCL Tech margins are at a 10-year low. You think it's going to get worse than this? If yes, what are you penciling in? And how much of that pressure is in the price already?
So we think across the industry, there's clearly very significant margin pressures. And some of this we think will be structural. Many issues are coming to bear right now, which is impacting margins for the entire sector. First of all, we think there's been a significant, or at least a beginning in the reversal of the employee-employer bargaining power and relationship, where we think increasingly employees are finding the barriers to exit a lot lower, and they are using to do that. And we've seen in certain cohorts, as a result, wage inflation, especially just to retain talent, backfilling costs have gone up dramatically, as much as 2 to 3 times. Secondly, we also see that companies are having to give a lot more wage increases, especially on-site wage hikes a lot higher this time, at least 2x of the increases that the industry is used to paying for the last 30 years, which is further compounding the margin pressures at the moment. And thirdly, the main medium to long-term solution that the industry is hoping for is graduate recruitment and graduate onboarding. And at the moment, there have been so many graduates which have been inducted that the industry is struggling to make them productive or make them billable. We've heard of situations where the acceptance of that with clients is a bit lower. Companies do not have the infrastructure to train and make these graduates productive because there's just been very low graduate hiring for the last 5 to 6 years, which has resulted in this problem.
Ankur, in terms of individual companies, what's your view on Infosys? Because among the large cap IT companies, that's been the top of the pack for many.
Unfortunately, we'll not be able to discuss any stock-specific views. I can talk about the industry.
Okay, so just one last question then. Since you said that in any case margins have fallen to historic lows and there could be some more pressure there, the other element is client spends, right? For now, client spends are fine. There hasn't been any major disruption. But as we head into an impending recession in the US, do you fear that even client spends could slow down, impacting even top-line growth? Is that something that you're looking at?
Yes, I think when we had downgraded back in May, we did highlight, and this is something that we are concerned about as well. JP Morgan had done a CIO survey back in June, which did indicate that incrementally a significant proportion of CIOs, we, for example, interviewed about or surveyed about 100 plus CIOs with a total spending of $125 billion globally. And that indicated at least 30 to 40% were expecting a slowing spending in the second half of CY22. And a very high proportion of that will see slow spending in CY23 as well. And about 35 to 40% were expecting a significant cut if there was a recession. So client spending being at risk is definitely a key concern for the sector.
Ankur, the IT sector has been a consistent compounder, right, for a decade, more than a decade and a half. Are you saying that all of what you're describing, is this a temporary phenomenon which maybe takes prices a little lower? Or are you saying the compounding itself is at risk of being kind of disrupted?
We think we are clearly at a point where the earnings compounding will not work for at least a year or two till the expectations reset. You're right, the IT sector has been a great compounder for the long term and probably will remain after expectations are reset. But the problem right now is there's a massive disjoint between expectations and what could actually happen over the next 12 to 18 months. If expectations reset to lower margins, which is what we think is increasingly likely, and growth slowing down, we've seen a massive increase in inflation of expectations between 2020 and 2022 because growth was increasing rapidly, partly because growth was brought forward or digital transformation was accelerated, and low interest rates also expanded multiples, which also effectively meant that expectations built into the stock prices were very high. So if we adjust through that, we can get back to a compounding phenomenon. But at the moment, that looks unlikely.
Quickly, Ankur, is the mid-cap IT place better?
What we do find is at the moment, last quarter, many of the wage increases were taken by larger cap companies. And this quarter, we think 7 of the 11 companies we track are taking wage hikes, including several mid-sized companies. So in the near term, there could be margin risk there as well. Mid-cap companies also, remember, tend to be at a slight premium to large caps. So if there is an imbalance between growth, performance, and what they can and what's priced in, there could be a challenge. So we at the moment have only underweights and neutrals as part of our recommendations.
Got it, Ankur.
There could be some companies which do better structurally, but in the short term, it's all at risk.
Ankur, we'll leave it there today. Thanks a lot for joining us. That's JP Morgan view. We run into the market opening. It's not bad at all. The Nifty, in fact, could turn in green. It's down only about 13 points. The mid-cap index is actually starting in the green, and the bank Nifty is down only about 40 or 50 points. Maybe the combination of the momentum from yesterday's second half and the fact that there was FI buying is helping the market. In fact, the Nifty, as I said, could very well turn in the green. It's about to do that. Nifty is in green now, and the bank Nifty as well in the green. So there's momentum clearly which is continuing from yesterday in the mid-cap market doing quite well. Let's talk about the stocks which are higher. ITC is leading it. ITC is up 2/3 of 1%. IT stocks are actually doing well today. So TCS, Tech Mahindra, both are higher. ONGC is up. Of course, crude's gone up, so that's helping. IndusInd Bank is doing well. Apollo Hospitals is higher. Kotak Mahindra Bank, which has been a bit of an underperformer, is doing well. Hero MotoCorp and M&M. The auto space has been on fire, so that's a bit of a relative strength concept playing out. Shree Cement is doing well. Cipla, Wipro. I mean, the stocks are not having any kind of momentum. The Nifty as well is absolutely flat, but flat is good given the kind of global context that we had. On the way down, we have Bharti Airtel, which is down about 1.5%. Axis is down about 0.5%. I mean, then most of the stocks are down about 0.5% or thereabout. Asian Paints, ICICI, HDFC Twins, they are a bit sort of soft. The other stock which is making a bit of a move right now is IndusInd Bank. That's up about 1.2%. As I said, ITC is the other one which is leading it. So that's looking quite good. But overall, SBI has turned in the green. That was a stock which had very strong momentum yesterday. So keep an eye on that as well. But overall, not a bad opening at all. The Nifty is actually up 10 points and the Bank Nifty is up about 64 points. Sonia, over to you.
So, it's a good opening for the mid-caps, Anuj. 140 points in the green, 0.5% higher. Advanced decline ratio is quite good. The stock I'm watching is Affle India. It's up 5% right now. Goldman Sachs has initiated a buy on that stock. They have a target price of 14.95 on Affle India. It's slightly higher than where the current market price is. So that is, of course, one stock that I'm looking at. Apart from that, everyone's watching NDTV. It's still up. Despite the rally that we've seen, NDTV is still up about 5% Keep an eye out there. The whole consumption space has been doing really well. So today you have, these alcohol stocks, Radico, Khaitan, United Spirits. It's not even midweek. And look at the rally there. Big volumes as well. Phoenix Mills is doing good, up about 3.5%. Sun TV. So this whole consumption, entertainment piece is looking good. United Spirits picking up pace now. Apart from that, some of these mid-cap IT names are coming back. Happiest Mind, Persistent Systems are looking good this morning. Volumes also picking up there. MRPL, Tanla Platforms, a couple of other names that are gaining ground. Campus Active, Devyani International, Easy Trip, Gland Pharma was up for the last few days. That one's looking pretty good. Bata, Dixon Tech are a couple of other names. So now the market is getting a bit volatile, so don't lose sight of that. The Sensex and the Nifty have drifted into the red. So what's dragging the markets lower? Some of these Adani Group stocks. Adani Power is down about 5%. Zomato is down about 1%. MEP Infra, GAIL, Tata Power, a couple of other stocks. These paper stocks have been doing very well. So I just want to make a special mention there. JK Paper, Andhra Paper, etc. have all been in the green for a while. So do keep an eye out on those names. But otherwise, it's kind of flipping between red and green, but a lot of stock-specific action.
A lot of action, Sonia. You mentioned Affle, which is up 5. Radico is up 2%. And I'm only going to touch upon things with volumes. Chennai Petro is starting about 5.5% higher. So that's another one at about 321. There is Shanti Gears, which went up, I think, 15% yesterday, maybe more, which starts another 1.5 higher. GE Shipping was up about 5-6% yesterday. It starts another 2.5% up, so about 561. Oil India is starting 2% in the green, 189. There is Phoenix Limited, which is up 3.5% on decent-sized volumes for this time in the day at least. What else? TV today is up 7%. You know, we were just having that discussion with Karan Thorani, who was mentioning that just compared to what the transaction of NDTV has been done, and TV today, of course, is at a sharp discount, 7%. It's coming up on volumes as well for this time in the day, again, to emphasize. And there is SpiceJet, which is up about 2% as well. On the downside, I mean, it's 3:1 in favor of advances. So, you know, many more advances compared to declines. But for what it's worth, there is Adani Green, which starts about 2% lower. Adani Ports is down 1%. Adani Wilmar is down about 3% or so. So we saw some pressure on these stocks yesterday. Adani Power is down about 5% as well. So that pack is seeing a little bit of pressure as we begin today's session right now. The other one is HDFC AMC, which is down 2%. Adani Transmission, by the way, is also down about 3% or so right now. Bharti down 1.5%, and Zomato down about 1.33%. The other names on the downside. So this is still, I mean, very, very tentative in terms of a start. A little higher and now a little lower. 20 points down with what 5 minutes of market open behind us, 17,560. Our market master of the day is Gautam Trivedi. He's co-founder and managing partner in Napian Capital. He's joining us right now. Gautam, it's always a pleasure. Great to have you with us here on the channel, on the program. Thanks very much. You've been very cautious on markets, but we got this very large rally higher, which is now starting to reverse itself. How are you thinking about what lies ahead in the near and medium term, Gautam?
Sure. I was reading a report early this morning by a bulge bracket firm that had surveyed 800 US hedge funds.
Oops, Gautam, we can't hear you.
Okay, can you hear me now?
Yes, we can. Go ahead.
Yeah, sorry. I was saying I was reading a report surveyed 800 US hedge funds with $2.4 trillion of gross equity exposure. It showed that year to date, these funds are the average performance is a negative 9%. In fact, for the first half of the year, it was a negative 12%. There's been some recovery, of course, in the.
Okay, I think there's some issue with your audio, so we'll try and fix that in a bit. Let's just, before we fix that audio, let's just get a quick handle on what's happening in the market as well. The Bank Nifty is the only one that's actually a tad bit in the green right now. A couple of stocks to deserve mention. We were telling you about Chennai Petro and how, the JV with IOC and seed equity investors has come through. So that's up almost about 5.5%, looking pretty good. The JV will be implementing a 9 MMTPA refinery project worth 31,000 crores. So that's big for Chennai Petro. That stock is up 5%. But Gautam, I think, is back with us. Gautam, sorry, there was some issue with your line. Go ahead. You were telling us about your expectations on the market.
Yes. So I was saying that I was reading this morning a survey by a bulge bracket firm that surveyed about 800 US hedge funds with a gross equity exposure of $2.4 trillion. The average performance of these hedge funds year to date has been a negative 9%. So that tells you how difficult it's been in 2022 to actually make money. And I don't think that's necessarily going to change between now and the end of the year. Do keep in mind is the fact that I was recently in Singapore the week before last, met over about 10 to 12 investors. A lot of these are friends. And for the most part, I think about 80% of them found that the market in India right now is way too expensive. So if you actually look at the absolute numbers, MSCI India is at 21.3 times, which is more than double MSCI emerging markets and MSCI China. So I think this pullback, and of course, historically, India has been expensive, but 100% premium over both these indices, I think, is way too high. And hence, I'm not surprised with the pullback in the markets.
Pullback in the market today, by the way, just seeing a bit of a reversal once again. The Bank Nifty is in the green now. Reliance is leading the market on the upside now on the Nifty. Just look at that. And these tier 2 banks, and we saw the move yesterday in names like RBL Bank. Today, Bandhan is joining in. RBL, of course, itself continues to rally. There's IDFC First Bank, IndusInd Bank. That space has done well. Gautam, good morning. The tier two banks, that's where we're seeing some rally. Is this just pure valuation play which is playing out here, or something more?
I don't know specifically to today what's going on, but I think in general, the tier 2 banks, really the preference for us has been more of the tier 1 private banks versus the tier 2 banks. And I assume that you're including a lot of the PSUs in the tier 2 because from a market cap perspective, with the exception of SBI, most of the other banks are actually tier 2 from a market cap perspective. So I don't know, I can't comment on what's really happening today, but we continue to remain positive on the tier 1 private sector banks.
Okay, remain positive on the tier 1 private sector banks. Well, I wanted your thoughts, Gautam, on all that's been happening across the IT space, because over there, I agree. I mean, there are, of course, margin pressures. Now, variable pays are being held back. But at the end of the day, all these are cyclical problems, right? Structurally, do you think that the IT piece is still intact, or would you be cautious?
You know, there's a mixed view out there, and I'm also personally confused. We do own Infosys within our portfolio, which hasn't done too well. We bought it, I guess, a little too early before the correction actually happened. But having said that, I think if you look at the first quarter results, you've seen the tier 1 IT companies grew only 1.7% quarter on quarter, with the exception of Infosys, which was up, I think, about 3.8%. If we look at the tier 2 companies, led by Persistent, which grew remarkably well, 11%, and then the average has been about 3.5%. I think the good news I see is that the companies are finally pushing back on the wage hikes, especially on lateral hires. And that's something which I think needs to be controlled. You know, there's a big hue and cry about controlling wages of actors in Bollywood. I think that's a little similar in some sense to what the IT companies, software engineers are doing. The moment they get an offer letter from one IT company, they're shopping that around to 2 others or 3 other IT companies and then going to the best bidder. So I think that's something which the IT companies are not pushing back on, which I think is going to be better for margins. So I think some of that nonsense has to stop.
So how do you approach it then for someone who perhaps has IT stocks in their portfolio, right? These large cap or mid cap names who've given them great returns in the past. Do you churn out? Do you stick to these names, keep the faith? What does one do?
I would keep the faith. And I think a lot is going to depend on what happens on Friday when Chairman Jerome Powell makes his statement with respect to interest rates between now and the end of the year. So I think a lot of that is going to be impacted. In fact, I was reading the Wall Street Journal, and what that said is that from Macy's to Nordstrom to Best Buy and Walmart, everyone's basically guiding down between now and the end of the year. So I think a lot's going to depend on where the U.S. economy is going to be, depending on what the interest rate cycle is going to be from the Fed.
By the way, just a word on Bharti. I think this is something Nimesh actually alerted us in D-Street Chatter yesterday that they're expecting a big block deal in Bharti Airtel. Singtel is likely to sell, and if you see the depth on the Bharti stock on the NSE, there are 1.96 crore shares outstanding on the buy side, and on the BSE 1.9 crore as well. So almost 4 crore shares. That's the market depth if you look at the bid and ask for any stock. So maybe a block is expected. Whether it happens or not, we'll find out. But there's clearly chatter in the market, which Nimesh alerted us that there's likely to be a block. Gautam, this is a stock which has done well, Bharti Airtel. Now with the problems that Vodafone is facing, do you think this could still be a bit of a consistent compounder from here on?
I think it could be because the expectation is, and I think this should play out, is the increase in ARPU gradually, which is already starting to happen. So I think it boils down to, literally every 10 rupee increase in ARPU goes straight to the bottom line for all of the telecom companies. And now that we're down to effectively 3, with one clearly having financial distress, i.e. Vodafone Idea, I think the only real listed play in India currently is Bharti, and hence I think I would think that's a stock that could potentially be a compounder.
This is markets getting pretty volatile, although in a very, very tight range. So there are sellers coming in as soon as the market moves a little higher, and then it gets bought on the way lower as well. Gautam, in the practical sense, the point is if one thought, and many would have looked at and marveled at the pace at which the market came back very quickly to almost 18,000 and felt that they missed out, right? And if there is now another leg coming, first of all, do you believe that? And is it going to be meaningful enough to kind of buy what you could not first time around? And what's the time frame one should keep in mind?
Yeah, Prashant, the question is, what I said earlier about India being expensive. But let's not forget, domestic Indian investors who are putting money either through mutual funds or directly through discount brokerages don't really care about how expensive India is vis-a-vis the rest of the world or emerging markets or the Asia-Pacific region. So for them, this has been a consistent form of investment for the past 24 to 36 months, which is what we've seen. And of course, we've seen a product penetration of the equity investment culture in our country, which is obviously positive. But having said that, my concern is that whenever the RBI ends up hiking rates in step with what the Fed will eventually do. So, we're looking at potentially a 50 basis points hike in September and another 25 each in November and December. Now, if that were to happen, and if interest rates do go up in India as well, simultaneously by 50 to 75 basis points, fixed income will start becoming more attractive to the average Indian investor. So incremental savings, which I would say a large proportion of today still going into the equity markets, will slow down. And if FIs don't come back, that's when you actually start to see a correction. So I think let's wait until what happens on Friday. Let's understand the statement from Chairman Powell, and then I think I'll be in a better position to answer that question.
Okay. Particularly in the auto space, Gautam, we've had some big launches come through. There is a huge demand coming back, but it's happening concentrated in the passenger vehicle space, not so much the other pockets. Is this a space that you like, and are you putting any fresh money to work here?
That's a space we like. We've put some money through the auto AMCs, which obviously we've chosen two, which we think are immune from the EV cycle that's coming. But having said that, I think the auto sector in particular actually is looking very, very attractive from an absolute demand perspective. So, so I met an investor in Singapore who said, gee, we've only gone from 2 million passenger cars sold 10 years ago to now 3.5. So, India is really not up there. But will India ever catch up to China, which sells 27 million annually? I think that's a tall ask. But even if India goes from the current 3.5 million annually to 7 million, that's a huge demand explosion that's happening. I think if you talk to the average auto dealer, and we talk to a lot of them for channel checks, the demand continues to remain robust. And I think what you're also seeing, interestingly, is the premiumization in the auto sector. So a lot of these entry-level cars, I think, are now falling out of favor. If I look at one stock, which has really surprised me at a personal level, is Mahindra & Mahindra. And this is a stock that at the start of every year, we say, will this be the year for Mahindra & Mahindra? I think it's finally starting to happen. We don't own the stock of this, making a comment.
Okay. All right. We will leave it at that. Thanks a lot for joining in. If you own the stock M&M, congratulations to you. If you don't, as you said, well, I guess you missed out. But thanks a lot, Gautam, for joining in and giving us your view. Well, let's get back. The market for now is absolutely quiet, actually. Flat. The bank Nifty is just holding up a tad bit, but otherwise it's just consolidating around these levels. Well, yesterday we told you that Apple has decided to begin making the iPhone 14 in India just 2 months after China in a move to reduce dependence on the country. To discuss this and the overall business outlook, we're joined by Saurabh Gupta, the CFO at Dixon Technologies, who's also in this space. Saurabh, thanks a lot for joining in. First, on this move of Apple manufacturing the iPhones in India, how do you think it could change the industry dynamics?
Oh, that's a big one because clearly, as you rightly mentioned, it's just been 2 months that China manufactured this iPhone 14, and within 2 months, India started manufacturing. So clearly, the strong policy framework, the government policies are clearly playing out, and Apple clearly wants to make India as a manufacturing hub. Internationally, they want to shift some of the supply chains from outside China to India, and India is a big beneficiary. So overall, this electronic industry would really benefit, and it is a big one for India.
Saurabh, hi, good morning. But could you, so that's a general comment, but could you, specifically, how will this play out in your assessment? You would have a slightly deeper understanding, right? What does it mean for the Indian ecosystem, manufacturing ecosystem?
Yeah, so if you look at the whole mobile production link incentive scheme, there were 5 foreign players who were given this approvals and 5 domestic guys, including players, one of the companies in which we were a beneficiary in the domestic category. Now, clearly what it does is that the bigger guys of Apple suppliers, Foxconn, Pegatron, and Wistron, they will make bigger investments in India. It will help in creation of a component ecosystem in India, which will ultimately be a beneficiary. Everybody, all of us will be a beneficiary of that. and ultimately India will emerge as a manufacturing hub for not only catering to the domestic market, but also for serving the global markets. So Apple clearly wants to make a big manufacturing hub and source a significant portion of its global production out of India.
What does Apple make in India right now, Saurabh?
It's done in South India by this Foxconn, Pegatron, and Wistron. So these are the suppliers. But what it will do once these bigger guys come in.
What products, Saurabh?
Come again?
What products are made right now?
So Apple, as of now, is making. These guys are only making iPhones for them. The iPhone 12, 13, 14 are getting made in India.
Okay. Coming back to your own business, can you tell us what are the demand trends looking like now? Because we spoke to you during your Q1 numbers, and a lot of those, there's some pressure that you're seeing, especially in places like consumer electronics, which saw a fall of around 26%. The growth in some of the other segments has also slowed down a tad bit. There is a lot of competition, but can you just tell us segment-wise, what kind of growth are you looking at? Where are you still facing stiff competition?
So Sonia, the demand across all the verticals looks very healthy. So we have a very strong order book across all the verticals, and in most of the verticals, we are running at 100% capacity utilization today. So we are looking for a very good festive season, and we hope this momentum continues beyond the festive season as well. So we are clearly looking at a strong Q-on-Q growth as well as Y-on-Y growth this quarter.
Saurabh, sorry, just to kind of complete that point on Apple, is there any opportunity, is there any way Dixon can participate in this entire thing?
Yeah, we would love to participate. Clearly, as you know, we are already manufacturing for some of the global brands like Motorola, Nokia, and some of the Indian brands. But yeah, if given an opportunity, why would Dixon not like to participate? Clearly, it's a big opportunity, and if opportunity comes to us, we would definitely like to participate.
As of now, it isn't there, right? You'd like to, but as of now, yeah, okay. You know, the last time you were on, you'd said that you'd basically lowered the FY23, the full year revenue growth, by about 10%, 7 to 10% as compared to what was earlier assumed. How's that playing out? I mean, you know, I was looking at the last month sort of cell phone sold data, I mean, smartphone shipments data, that has seen a very sharp dip. So are things slowing down more materially as earlier assumed, or would you stick with that earlier guidance that maybe, you know, it'll be 7-10% cut and not more?
Yeah, we would stick to that guidance because clearly what you are mentioning is we also saw a dip in both Q4 and Q1 in the mobile shipments, and clearly the domestic market slowed down for mobile phones. However, in our case, basically we are exporting a significant portion of our mobile phones to North America markets for our anchor customer. So that market continues to do well. But yeah, the domestic market is presently was slightly slower, but it's getting better month on month. And as of now, our order book with our anchor customer and other customers in mobile looks healthy for the festive season.
But also cut your volume guidance for TVs to 3.6 million from 4 million earlier. And you had said that there's a global slowdown in the TV segment. This is when we spoke last. Will you hold on to the 3.6 million target, or do you think that you may have to slash it down further?
No, we are confident of meeting 3.6, 3.7 million. So there should be a volume growth of almost 20% from similar numbers last year. However, in terms of revenues, the growth may not be, will be muted because the prices of the display, which is a significant component which goes into making an LED TV, those prices have come down. And it's a prescriptive business for us. And basically the prices are just passed on to the consumer. So the margins will optically look better, but in volume terms will grow by 20-25%.
Okay. So overall, what would this mean? You said that the margins for the full year would be at around 4 to 4.5%. At least this was the guidance earlier. But you also told us that commodity prices have cooled off, freight costs have come down, and that will benefit margins. So how much do you think all of this would impact the margins, by the end of the year?
Yeah, so Sonia, if you look at our ODM business margins in Q1 against the Q3, Q4 of last year, those have been on an upward trend, and we see that trend would continue because clearly the sea freight rates have come down, the commodity prices have softened, so which will have a positive impact on our ODM business, which is almost 20% of our revenues. So yeah, we stick to that guidance of 4%. I think so 4.5% would be tough, but we stick to the guidance of 50% growth in revenues, 45 to 50% growth in revenues from last year, and a guidance on margin should be somewhere around 4% this year.
Right. Saurabh, broadly speaking, is there, that's the feedback when we speak with analysts, etc., who track the space. Is there pressure on volumes? So while people are expecting, so for example, take the July to August period, July to September period maybe, right before the festive season sort of gets in full swing, sort of flat to 5-7% kind of value growth, but volumes are expected to be flat. Is that a fair assessment?
Yeah, industry may not grow that much, but in our case, we are growing and we have a very strong order book, and we will have a very strong growth because clearly we are the brand behind the brands, and we work across for multiple customers, and some of the customers for whom we are manufacturing are relatively doing better in the marketplace. So we will see a significant growth, but you're absolutely right. The market growth may not be that much what we saw last year.
Okay, all right. Saurabh, thanks a lot for joining in and talking about the demand picture. So that is Dixon Technologies. Let's slip into a quick break. Up next, we'll connect with Pawan Kumar of IGL to discuss the increase